just learn from book some knowledge. That's knowledge in your head. It just occupies some space. It's, you reflect, and thank you for sending me the reflections on email. When you reflect, you share, then you bring to another level of consciousness, and then you can apply in your business and in your life. And that's real skill. That's real precious. Okay. So for example, today we're going to learn receivables, and then you will see, okay, how can you deal with the receivables? How can you, or maybe, get rid of receivables? And in the receivables, there's a business like called a factoring, there's a business there also. So start to connect these to your business, whatever business you're doing, right? In your business, in your business, I wouldn't deal with receivables. I would just have them pay upfront. I would rather just give them a little bit discount and pay upfront, give them incentives, right? So this way you eliminate the cost of somebody calling them, chasing money like that. So I get rid of receivables completely. All my clients, even just a regular tax client, you do a tax return, it's like $1,000. I just use $1,000 divided by 12 and then connect automatically monthly payment. This way, I don't need a person to, take care of receivables. And then I also give them an advice saying, oh, look, you pay me monthly, that means we have a relationship. So you can call me anytime. You can book a time on my website and get my advice rather than transaction. So I kind of distinguish that as well to my competitors, rather than, okay, come here, I do a tax return for you and charge you $1,000. Most competitors charge $500. I charge double, tell them, hey, I'm better, good, right? So, because I, give you more advice. Right? So that's how you can play as game in life. So next week, chapter 8, receivables, bad debt, expense, and interest revenue. So we want to describe the learning objective, describe the trade-offs of extending credit. Well, you extend the credit, which means instead of paying you immediately, you can tell them, okay, you pay me, after months. So the advantage is you increase the sales revenue, and then the disadvantage is you increase the wage cost, bad debt costs, delay the receipts of cash. So for me, my own experience, in my business, it's really about me taking stand, telling them that I'm good. Okay, so you want to do business with me, pay upfront, and pay me monthly, like that. So I think in my business, what I learned, the entire process is a personal growth. It's a self-development. Okay, the first time, my first client was I did a tax return for her, $40, and then the check bounced. Okay, so that's how I was, like my self-worth, right, was there. It's like I was wondering, okay, this looks like easy, everybody can do it. How do I justify charging people? So I wasn't confident, and I wasn't feeling the self-worth. That's how I attract, small clients like that. And then even the check bounced after I filed a tax return for the person. So, and then later I charge $500 a month. Charge $500 tax return, and then I remember a friend of mine asked me, how much do you charge? I say $500, and he's like, oh my God, people charge $200. I said, that's okay. You can go for other people. Now, in order to become my client, the minimum. So first of all, now I say I do tax planning. Okay, so the tax planning, I charge a $2,000 engagement fee. That's a privilege to do business with me. Okay, I haven't done anything yet. So if you want to engage with me, you pay me $2,000 upfront, and then you pay me $500 a month for a minimum commitment of a year. Okay, so my promise is I can save you at least, 3 times, like $30,000 at least. I can save you money. Okay. Now the clients usually, these clients are making at least $200,000. They're paying like $60,000 tax. So come to me. Okay, I can save them at least $30,000. That's something I can promise. Depends on what strategies you use. You could potentially save all the money, right? So they're willing to pay, and I speak with confidence. So they're willing to pay. Now I say tax. I can do tax. Other people can do tax. My fee is more expensive. Okay, you can go to HR Block and pay $200. If you want me to do it, I charge $1,000. Now, a lot of time people still want me to do it, because once they trust you, right, they want you to do it. So okay, I'll do it. $1,000. Okay. Now I don't do it by myself anymore. My people are doing it. So that's how you elevate. And then because I'm doing monthly fee, right? There's no accounts receivable. Because before I bill them after my service, and sometimes I forget, and sometimes they don't pay. Sometimes they forget too. So now I say, okay, in order to serve you, you need to pay me first. So it's a stand you take. Okay. And the same, like Noah, if your business, ask them to pay you first, and then set on monthly, right? And then like I'm attending a dance class, so I pay first. Sometimes I show up, sometimes I don't show up, but hey, for them, they already charged me, right? And in a way, it's also service to me. If I don't pay, I may not appreciate it. I may not go. So it's better that I pay. Okay. So really, from the business perspective, right? What do you think? And if you can eliminate, if you are the sales side, if you can eliminate accounts receivable, I would highly encourage you to do that. So estimate and report the effects of uncollectible accounts. So let's say accounts receivable, you have, when it happens, you debit accounts receivable, credit sales revenue, and then you record estimated bad debt by creating something called allowance for doubtful account. And then you book bad debt expense. Okay. So you basically debit bad debt expense, you increase expense, and then you credit allowance for doubtful accounts. Now, just like the allowance for the inventory loss, this is the contra account, just like depreciation to the fixed assets. So this is a contra account to the accounts receivable. In a way, you can think, okay, instead of doing allowance, you can just say, reduce accounts receivable, right? But because it's an estimate, we don't know if it will be true. Let's put this one, and then accounts receivable reduced, just by having another line saying less. Okay, that's a way of presenting it. Again, all the accounting, all financial statements, it's a story you tell, right? It's how you present it will help you understand, help your managers, your CEO understand the business. Okay, this is allowance for doubtful accounts. So conservatively, we already have counted for bad debt expense. Okay, that's good. And then this allowance maybe indeed become true, maybe not. There's still a possibility we can still get a fully paid. So you allowance for doubtful accounts, and then if the bad debt happens, this indeed allowance happened, then you just get rid of the allowance. So you basically debit the allowance and then credit accounts receivable. Because the bad debt expense you already booked, you can't book anymore, right? That's why you just get rid of allowance for doubtful account, and then of course the accounts receivable related to that is also gone. Okay, so that's how it works. The two-step. So the allowance method follows a two-step process. First, record the estimated bad debt in the period credit sales occur using an end of a period adjustment. So at the end of the month, you estimate maybe 2%, right? And then you remove or write off specific customer balance when they are known to be uncollectible. So it's certainly sure they're not going to pay it. So adjust for estimated bad debt. First step, assume that this company estimates $900 in bad debt at the end of the accounting period. Okay, you book bad debt expense, $900, and then you book allowance for doubtful account. Okay, which this one is a negative, it's a credit side. Okay. So bad debt expense increased $900, allowance for doubtful accounts increased $900. And the steps, the first accounts receivable, $120, you book the whole revenue, $120, and then you estimate at the month's end, $900 will be bad debt, so you have an allowance for doubtful account. And then on the balance sheet, the allowance, it's a negative amount, so it reduces the accounts receivable. You report it here, okay? And then the income statement, you've booked the bad debt expense here, so the income is less, so you become conservative. Make sense? Okay, everybody make sense? Good, thank you. Yeah. So you actually write off accounts receivable. So here, now $800 is sure not collectible. So you write off the accounts receivable and write off the allowance for doubtful account, both of them. Okay. So write off specific customer balance. So this is how we did it. Step one, the bad debt expense, and then this one, you reduce it. Okay. And then on the accounts receivable, you get rid of the $800 completely. And then the bad debt expense, yes, we already booked. And then here, the allowance, the bad debt expense is here. And when you write off allowance, the $800, and then you have the note, have the total. So the method for estimating bad debt. So here, there's no really the most scientific way. So we needed to just choose something that is feasible. First, we could choose the percentage of credit sales method. So that's simple. We just look at the past months, the past how much is not collectible, and we assume it's most likely the same. Okay. And another way is agent of accounts receivable. This is more scientific, more accurate, because the assumption is the longer the agent is, the unlikelihood, the higher the unlikelihood to collect the money. Okay, so that's the agent method. So the percentage method, let's say last month we have 0.75% uncollectible. Okay, let's assume that. Okay, so we can do the same this month. Now, agent, the way you do it is you list out all the accounts by age. And then in QuickBooks, you can print AR, accounts receivable agent summary. So it will show you this report like that. Okay. So because the day you create an invoice, that's the day the accounts receivable starts, right? So by any day, you can print this AR agent report. So now you can say, okay, the longer ones, have a higher percentage. Let's say over 90 days, let's estimate 40% uncollectible, and 60 day to 90 day, 20%, like that. So you can create the estimated uncollectibles. Okay. Now, in real life, what's more important is the ones who are over 90 days, you want to pick up the phone and call them. They probably forgot. That's more important, right? In real life. Mm. And then also you need to learn lesson, okay, if this client has a habit of not paying you and you have to call them, you need to think about that. Okay? For me, it's just increasing fees. And then sometimes they'll leave. If I'm willing to pay, good, that's fine. But a lot of times they just leave, and that's a good thing also. So, so let's say now the AJ is saying bad debt expense, allowance for doubtful accounts. So sometimes you need to revise the estimate. So the way we do it, and then also account recovery. Sometimes you write off, but hey, surprisingly they paid. So how you adjust it? So you basically, let's say, assume that they collect $800 from East Fashion that was previously written off. This recovery would be recorded with the following journal entry. So you have accounts receivable, $800, and then if you just texting, it's gonna be distracting to me. Okay, are you understanding everything, or is it too boring, too slow? Okay, I can go a little faster. Okay, yeah. Let me know. Okay, if it's too slow, you're getting it right. You're getting it easily. Okay, I go faster. I go faster. Yeah. Okay. So you basically write off the reversed accounts receivable by the accounts whatever you have written off, and then you receive the cash and then you reduce accounts receivable. Okay, so that's how you recover. So compute and record interest on notes receivable. So sometimes most of accounts receivable are not interest accrual, but if it's notes receivable, you can basically say I'm going to lend you money. So in this case, you will receive interest. So the interest, you have the principal times interest rate times the time. That's how you accrue interest, right? So in this case, let's say you have $100,000, 6% matures in 2 years. So from January to December 31, your rate 6%. So that's the whole year. So you basically the whole year, that's $6,000 interest. And this one, it's only 10 months. So you basically 10 months, that's the interest, right? And this one, it's 2 months. So you receive 2 months of interest. You accrue that interest. So in this case, you have the year end, you need to record the interest income and then interest receivable. So in this case, there's 2 months interest you need to book. And then when you receive the money, you book the rest of the interest and then the receivable, it's gone. Okay, so that's how you create that. So when you give them money, you book notes receivable and credit the cash. And then with interest, you accrue the interest income for the 2 months on December 31. Usually before you close at the year end, you need to look at these things, right? Accrue, that's accrued accounting. So you book the interest receivable and the interest revenue. And when the interest received, it's total $6,000 now. $1,000 you already accrued. So the $5,000 becomes interest revenue. And then you reduce the receivable and you receive $6,000, right? Make sense? Everybody make sense? Yeah. So, and then you receive the principal, you basically receive cash. So remember last time we did the turnover for the inventory, right? So it's the same way. Accounts receivable is also the turnover. The more you turn, that means you can make more profit every time you turn. So the way we do it is we calculate the turnover times first. So the sales revenue, net sales revenue, which means gross sales minus the return and allowance. So net sales revenue divided by average net receivable, which is beginning and ending receivable divided by 2. That's the times you turn over. And then by 365 days, you divide by time 10. Every 36 days, your accounts receivable turnover. Okay, that's how you measure it. So if it's long, that's where you need to improve efficiency. But also you look at the benchmark, what other people are doing, right, in comparison to your same industry. If they are having less time, or then they are more efficient, and you are competing with them, you need to look at your business. Can you improve it, right? So factoring receivable. Accounting is very interesting. Even just accounting itself, within the financial service, there are a lot of businesses. So factoring basically says, you have an accounts receivable, and I have cash, and you need a cash. So let's make a deal. I'll pay you. This accounts receivable is $100,000. You receive looks like 3 months later, right? Well, let's say, are you willing to pay 10% interest, and then let me pay you? Let's just factor, right? See if I can pay you, $90,000 to get your $10,000, $100,000. So you got the $90,000 now. Later, 3 months later, I receive the $100,000. So I make $10,000. Okay, that's factoring business. I know somebody. I was working for charter schools in California. So the charter schools, they will receive money from the California Department of Education. For sure, they will receive it, but they're always late. They're always late. And this one man, he's smart. He knows this system. He knows that he has no problem receiving the money. So he make a deal. He created a company called the Charter School Financing Company. He's the only company that's doing that. And then he tell these charter schools, he go to these charter school conference and tell these charter schools, look, if you have, I can buy your receivable. This gentleman, he happened to know the system, so he had confidence he will receive the money. And then, the charter schools, they're desperate when they don't have money to pay teachers. They're willing to sell. And honestly, a lot of times, they don't understand that they're paying a deep discount, like in terms of the finance side of it, the interest rate, they even don't understand. But for them, they're so grateful. You saved my day. Now I can pay the teachers and keep the door open. Right? So these are opportunities. So it's called factoring. Okay. Now another way is credit card sales. Here's one thing. Let's let them charge a credit card, and then you get the money, right? And they'll pay. On the other hand, also, like your business. In the beginning, you may need to create a website. You may need, some social media, some help. The easiest way, instead of going to the bank and getting money or whatever, charge your credit card to begin with. I know one guy, he was doing training I met him in my college. I was a college student, and he came to the training. I train you about your positive attitude, your leadership, your vision for life, and all of these. And all he needed is travel cost and some, create a website. And he just charged his credit card, to start his business. He was in his 20s, and he's very enthusiastic and inspiring, and he's able to inspire the college students. Yeah. So, start your business with credit card. Very simple. So don't a lot of time you think, starting business costs you so much money, the $50,000 to buy something. Start with something new, very simple, something that you can do. I think in today's world, a lot of business can be service business. And if you have a skill, you have some resources, connections, the medical device person, like real investment is just your time and energy. And you have that anyway. If you don't do it, you get distracted anyway, watching YouTube or Netflix, right? So really, like, just do it. Just do it. It's not that difficult. Mm. So you record the bad debt using the direct write-off method. So we talked about the allowance method, and then there's a direct write-off method. Direct write-off method is basically, okay, you book it fully, but when you know this you can't collect, then you just write off at that time. Okay. Now you just write off directly without going through the two-step allowance. You just say bad debt expense, and then you write off accounts receivable immediately. Now, write-off method is not a gap. Okay, so when you're doing the gap, especially if you are a public company, you needed to do the allowance method, because the write-off method sometimes is not matching the time when, it's not matching the same period. And also it's not a conservative method. Okay, so the gap says use the allowance method. So using the interest formula to compute interest, let's say complete the following table by computing the missing amount. So the principal times the interest, because this is annual, right? So this is 6 divided by 12. That's the interest earned. So this is the formula, always the formula. And then whatever is missing, here, you can just do this. I guess you learned these maths in junior college, right? Junior middle school, right? These are, simple maths. You can calculate these numbers, okay? So compute bad debt expense using age of accounts receivable. What time is it? 2:30, okay. So I'm not going to read all these, but very simple. You just list out the accounts receivable by the dates, and then you calculate the percentage based on a percentage. Okay? And then you put the journal entry in there as an allowance, bad debt, and credit allowance. Okay, so that's how it is. And then here, by this one is by sales. Oh, it's also by percentage. So the write-off, as we said before, you have the account receivable, sales revenue, and then you book the allowance, and then accounts receivable and allowance. When you recover it, you basically reverse it, and then you just receive the cash, and then you get rid of accounts receivable. Okay? And then whatever it's the estimate, you always book bad debt expense, and then allowance for doubtful accounts. Okay, so that's the impact on the receivable, sales, and the income from operation. So in this case, again, you have the number of days, and then you have the estimated percentage. That's how you calculate the receivable, the allowance. So accounting for accounts and notes receivable. So again, accounts receivable, you book the full amount, and then whenever you do an estimate, you increase bad debt expense and then increase allowance for doubtful accounts. Okay, so that's the principle. And of course, when you have notes payable, you receive the cash and then get rid of accounts receivable. And when you recover the money, you reverse the accounts allowance and also reverse accounts receivable. So you have the allowance, continue to do that, and the cash notes receivable. Okay. So that's the interest we talk about. You book interest revenue if it's just 1 month. Now it's year end. You need to accrue interest receivable, and then you have book interest revenue. And then in terms of accounts receivable, you have the percentage based on agent. You estimate that. So on the balance sheet, you always present as accounts receivable, and then you have allowance for doubtful accounts, and then you have the net. And then you have the interest receivable. So here, this is again an AR agent, accounts receivable agent summary report. And based on your past experience, you can estimate the uncollectible accounts. And then you can book the allowance. And that allowance, in the income statement is the bad debt expense. So conservatively, we count with that. Okay. ChatGPT asks, when I do a business plan, what are areas I need to look into, or what an investor, what's the top 10 questions the investor will ask me, right? So I would ask you a few questions. One is, why you? Why you? Okay, you have to have something unique, something competitive. Okay, so like in your wedding, there's a company called Zola, Z-O-L-A. You can Google it. I think Zola.com. So they do wedding. Now their business model is that there is a business, is a platform on the website. So if John and Sarah are getting married, they will post their wish list, gift, what they want. And then their guest will go on there and they search John and Sarah, and then they see their wish list. And then they will pick, okay, this one I'll buy, this one I'll buy. And then the website, the company, they are making money by the supply chain. So because this way, basically in a way they are advertising, helping for the merchants, the suppliers to sell these products, right? So they will take a percentage of that. And then the wedding planning or wedding service, they can either provide it for free to attract the clients, or they can provide the wedding service, but they don't provide it. They again have suppliers to provide, right? And then they get a cut of it. So start thinking deeper in these ways, okay, like a business plan, and then really also look at your cost, being realistic, your cost and your revenue, okay, and then really getting your financials more realistic. Like in your case, also you've started the financials, right? And getting more realistic and more details and more solid, the things that you haven't thought about, creating financial statements. And then even also creating, as you have learned, right? If you need inventory, how are you going to keep track of inventory? In your case, probably inventory is important. Or, no inventory. And then receivables, right? I'm going to extend credit or not, right? Getting the nitty-gritties, like start to think as you continue to learn. Start to think of your business in a more detailed level, because accounting, again, is the language of business, right? Or what you learned now gives you basically another eye to see these things that you don't see before. Okay, and then do some research. Really, the key is business is competitive. You want to be competitive. People choose you because your uniqueness. Okay, like Noah's, his uniqueness is his passion and his skill, his love for the sports and his love for the people and his life purpose, meaning of contributing to the society, right? That becomes his passion and his purpose, and he put on his website, and when people interact with him, people can feel it, right? So think of these things, right? And I do think it's important, yes, the medical device seems like a good business opportunity to make good money, right? I think it's important you tie some meaning to your thing, right? Like you're providing a value to the society. In places they don't have access to the medical devices, they lose their life. You're saving their life. Okay, so I think you tie these intrinsic value beyond making money. That will carry you through when you're not making money or when you're having difficulties. Because ultimately, every human beings, we have this need to contribute. Yeah. Any comments, questions, reflections? Okay.
You basically want the next presentation is like more in depth than like the previous.
Yeah.
A lot more handful, kind of sell ourselves a little bit.
Yeah. Like as one is make your uniqueness very clear, okay. And two is like really practically thinking the demand and the cost, the supply of it, right, and make it feasible. Okay. Like I give Noah advice. Let's start with a training company, a website, right? Does not cost much. Here's the thing, okay? Everything we're doing, I don't want you guys to do it because it's a course and you can grade it. Come on. Grade means nothing, okay? 10 years from now. I really want you to start the business now, okay? Like my daughter is learning art, and we started business a long time ago. She bought when she's in high school. She bought these T-shirts for $3. We went to the Michaels, bought these blank T-shirts, $3 each, and then she put her art on it, and she sell for $40. And then she put on Instagram, people buy even online. And she put on a vendor, in school, in a table, she buy, she sell. And now she's in college, she's doing these paintings, and I ask her, hey, how can you make a business? Yeah, put on a website, put on Instagram. and put a price on it. Sell it for $600. Okay, somebody may buy. Okay, so really, life, business, is an essential part of life. And I want you to have that habit. And you're not too young to start a business, okay? Mark Zuckerberg started. It's like I was selling ice cream when I was 15. I bought the ice cream. Basically what I did was, mm, I had a bike, and then I made a box, just picking up some what people throw away, and then put some cottons inside the box to keep the insulation. And then in the morning, 5 o'clock, wake up early, go to the town, to buy like 100 pieces of ice cream, really just popsicle, for 25 cents each. And then I just go, village by village. And every time I go there, I yell, ice cream, oh, and then kids cry. Now I know business is coming, and I just wait there. If I call and then no kids cry, I know because somebody else came in front of me already. So I just leave and go to the next town. It's online business, okay? And then when I was in college, the second year of college, I went to do an internship in northern China, a relatively smaller town. So they're not as commercialized as the southern towns. So I'm from the southern China. So I saw they sell these sweaters for 300 yuan in the big malls. And then I can get it for 70 yuan in my hometown, in the factory. So I bought like a box of it. I didn't have money. So I basically partnered with my uncle, said, Uncle, you buy these, and then I can sell it. So they put like 10,000 yuan, and so I brought it in, I put it into the mall, nobody buy. I sold for 270, nobody buy, because in the mall, it's a branded one. My one does not have brand. So eventually I took it off and I sold it in my dormitory to the workers. And then one lady bought it for 270. And then she started to tell everybody, oh, this sweater in the big mall, it's $300, 300 yuan. This is 270. Everybody comes to buy from me. I sold it immediately. So my profit margin, you think about $70 cost. I sold 270. And then eventually, I shared some profit with my uncle, and the rest I put by myself. So business is just doing it. And life is business. Okay, just do it. Don't hesitate. Just hustle it. And you will have a sense of accomplishment. You have a sense of confidence and self-esteem, sense of control in your life. And it's not have a dream. The more you do it, the more confidence you have. Okay. I'm really serious about it. And if you feel contact me, and this is something I do for fun, don't feel like bothering me. If you are bothering me, I feel good. Yeah, good. Thank you.